All right, welcome everyone. Thank you for joining me today. Welcome to a webinar that's not nearly as scary as the title implies. Retirement for Generation X is indeed right around the corner, but in less than 30 minutes, I'm going to show you the path to a financially secure retirement. Now, so of course you're probably wondering, why should I believe you? It's a fair question. Well, my name is James Matthews, and I've been formally teaching a wide range of financial literacy topics for over 5 years to an even wider audience. I'm here today representing Consolidated Credit, one of the nation's largest and oldest credit counseling agencies. We have an A+ rating with the Better Business Bureau, and for the past 26 years, we've helped over 5 million Americans get back on the path of financial freedom. We're headquartered here in Fort Lauderdale, and our main mission is to assist families throughout the United States in ending financial crisis, solving money management problems through education and professional counseling. Specifically, I work for the Coffee Department, which stands for Knowledge of Financial Education. Coffee brings Consolidated Credit's wealth of educational material and one-on-one financial counseling to employees around the country. So we hear a lot about retirement fears from Americans of all generations. But before we talk about retirement, though, let's talk about who exactly Gen Xers are. Now, while there's no official government agency or private firm that decides these things, society has generally agreed that Generation X encompasses anyone who was born between 1965 and 1980. That puts them between baby boomers and millennials and are ages between 38 and 54. Now, given their current ages, Gen Xers have some specific issues when it comes to retirement. So today we'll discuss the challenges that Gen X faces and how to overcome them, how to use different retirement accounts and resources to your advantage, ways to start saving even if you're burdened by debt, tips for catching up on retirement savings, specifically if you're over age 50, and what you can expect as you head towards retirement. So let's get started. We'll start with how soon Gen Xers begin retiring. Polls have consistently shown that most Americans want to retire around the age of 67. Why? Because coincidentally enough, that's the earliest a Gen Xer can claim full Social Security benefits. If you claim those benefits at age 62, those benefits are sliced by 25%. So if we use a 67 age as a benchmark, Gen Xers only have about 15 to 30 years left to save for retirement. From what I'm told, that's not as long as it sounds. So, start now or you'll wish you had. Now, is Gen X ready for retirement? Most experts say no. In fact, less than 1 in 10 or 8% of Gen Xers is saving enough to retire comfortably, according to a CNBC report that quotes the most recent research. A quote from that same article says that researchers project that if you want to retire at age 65 and maintain your standard of living, you need to put 10 to 17% of your current income into a retirement account. And that's if you start saving as early as age 25. If you wait until 35 to start, you have to save 15 to 20% of your income to retire by 65. Now, while many Gen Xers started saving for retirement at 27 years old, they aren't saving nearly enough to live a long and fruitful life after working. Median savings is $69,000, which for many Gen Xers is between 1 to 2 years of your current salary. So consider this. Gen X men can be expected to live on average to 80 years old. For Gen X women, that's 84 years old. If they retire at age 67, like they want to, that means having enough money to last 13 to 17 years. Now, how much does about 15 years cost? Well, ARGI, a financial advising firm, polled Americans to find the median guess was about $500,000 is what they expected. Now, that's fine if you can live on $20,000 a year. Most of us can't, especially as inflation will eat into that. 20,000 as the years go by, it'll be less and less. So even if you can live on it, is that really the life you want to lead in your golden years? Not for me. But interestingly, 43% of Gen Xers know they're way behind on their retirement savings. Even worse, almost half worry about running out of money while they're retired, and worst of all, more than a third don't think they have enough money saved to retire at all. Some have given up entirely. 17% aren't saving or investing. So that means only about a third of Gen Xers are predict themselves that they'll be very secure in retirement. But before we talk about how to double that number, let's review some other troubling stats. Gen Xers face some challenges that parents don't and their grandparents didn't. For starters, previous generations had employer pensions. Good luck finding those today. They've been converted into accounts like 401ks or nothing at all. Then there's Social Security, which has been tottering on the brink of insolvency since the millennium, but is expected to run dry by around 2034 if Congress doesn't act fast. So that means Gen X might be the first generation since early in this country's history to totally fend for themselves in retirement. Not a great outlook. But it's not like Gen X has, a lot of money sitting around. They owe more than any other generation. Overall, their household debts total more than $230,000. And if you take mortgages away from that number, you still have a daunting $30,000 in other debts. That includes credit cards, auto loans, student loans. That number is still more than all other generations. Student loans are one of the major problems Gen X faces. The federal government says total student loan debt in this country tops $1.2 trillion. Gen X holds a lot of that debt. And when you combine that with the Great Recession, which hit during some of their prime earning years, you can see how much is stacked against this generation. If that's not enough, Gen X is being affected by the generations around it. Gen X is earning another nickname, the sandwich generation, not for a good reason. Many have adult children moving back home because they can't find work that will support them otherwise. That's currently happening with my sister and her young daughter. Daycare prices, man, they're out of control. And also at the same time, Gen Xers, elderly parents can no longer take care of themselves on their own. So decisions made out of love often come with a very steep cost. This trend will likely become more common since the census reports that almost half of all adults in their 40s and 50s have at least one parent age 65 or older. When you have so many financial burdens and are taking care of everyone, it's easy to see why Gen X can't save for their own retirement. All right, so that's enough of the doom and gloom for me. I don't know about you, but it definitely is for me. Let's talk about what you can do to overcome these setbacks. It won't be easy, and the first step sounds like a daunting one. Pay off those high-interest credit cards. Can't effectively save for your retirement until you stop paying someone else money. Easier said than done, right? Well, actually, there's professional help available. So first, finding financial balance isn't something you need to do alone. You can call a certified credit counselor at a nonprofit credit counseling agency for advice, or you'll receive a free debt analysis. And some, like ourselves, will walk you through a budget. Consolidated Credit is one of the nation's oldest and largest agencies, but if you don't call us, call someone because you don't want to deal with it on your own. As for budgeting, you're not stuck with a pencil and a pad of paper anymore. There are online personal financial management tools called PFMs for short, like Mint and Tiller, that allow you to type in your income and expenses, and the program will do the math and show you where you can save. Members of Life Credit Union have free access to a dynamic PFM called My Money. So make sure to check that out because it's quick and it's easy and it's a phenomenal tool. I would highly suggest it. But once you do that, the next step is to unlock the power of the 401k. Most folks are familiar with the general contours of these retirement savings accounts, but they don't fully appreciate all they can do. First and foremost, everything you deposit into your 401k is tax-free. This means more of your money is making interest over the years. Combine that with an employer match program and your savings gets turbocharged. So what's a match program? Not everyone has it, but if you have a match program, basically your employer gives you free money. Sometimes they chip in a quarter or 50 cents or, for every dollar that you deposit into your 401k. but there's a limit up to 6% of your salary. Still, it's free money, and the federal government says nearly half of all employer offer these matches. So, check it out. See if your employer does. If you're one of the lucky ones, take all your boss's money that you can. Seriously, at least contribute to get the full match, or you're really, truly doing yourself a disservice. People say, there's no such thing as a free lunch, but in this case, it's as close as you're going to get. But even for 401ks, unfortunately, there are limits to a 401k's power. While you're not taxed on the front end, you are taxed when you withdraw the money after age 59 and a half. Then again, over the years, that money earned you interest instead of going to the IRS, so it kind of cancels itself out. Two other restrictions, one about withdrawals and the other about deposits. First, if you try to take money out before you're 59 and a half, you face a tax penalty. Second, if you can't contribute more than $19,000 in 2019, although that limit keeps creeping up, last year it was $18,500. So you can't contribute more than $19,000 in 2019. So now, if we don't have a 401k, or even if you do, you should still explore individual retirement accounts or an IRA. There are two types of IRAs, and they do slightly different things with taxes. The traditional IRA works like a 401k. Your contributions are tax-free, but you pay taxes later on. When you're old enough to you pay the taxes when you're old enough to make the withdrawals. But with a Roth IRA, it does the opposite. You pay taxes on your contributions up front, but not on your withdrawals. Now, why do it that way? Well, you're basically banking on history repeating itself. Namely, taxes are going to go up, and you might end up in a higher tax bracket as you get older. So by the time you hit retirement age, you end up saving on the back end. And IRAs, they're really powerful retirement tools, but not quite as powerful as 401ks. For instance, a traditional IRA makes you wait to 70 and a half years old to make withdrawals without a penalty. Compare that to 59 and a half for a 401k. For a Roth IRA, there's no age requirement, but if that Roth IRA isn't 5 years old, then you'll pay a penalty. So now remember we talked about an expert that could help you get out of debt? Well, there are experts that can consult you to help you with your retirement investments as well. Now, while all retirement accounts use mutual funds to grow your retirement savings, not all mutual funds are created equal. Some out-earn others, and a financial advisor might be able to help you figure out which funds are right for you. The best financial advisors offer a free consultation where they'll gauge what's known as your risk tolerance. While mutual funds are among the safest stock-based investments, you can still play it safe or take some risks. An advisor will help you decide. But how do you know where to find a good financial advisor? Well, the first place you want to go to is a fiduciary. Make sure the financial advisor is a fiduciary. That means your advisor is registered and has taken a pledge to put your interests ahead of their desire to make a profit. Is that an ironclad guarantee your advisor will always act in good faith? No. There are bad apples everywhere, but it's as good as you're going to get. So by and large, fiduciaries have been a real asset to Americans to protect their assets. So they're the best course of action here. Now, of course, you'll also need to question your financial advisor. Find out as much as you possibly can. For instance, insist on getting a list of all the possible fees you can be charged. A good advisor will readily hand this to you without you even having to ask, so that's a good sign. Some advisors are fee only, which means they charge you but don't earn commissions on your investments. Others are fee-based, which means they mostly get paid through taking a piece of the investments you make. Now, there are pros and cons to both, often depending on your circumstances. But as you can see, investing, it can get quite intricate. While your financial advisor can certainly help you untangle all the jargon, you still need to do some homework on your own. After all, it is your money. Thankfully, there's no shortage of easy to digest definitions online. I'd suggest Investopedia. You don't need to study it all, but you do need to know enough to ask the right questions of your advisor. Now, you might wonder, even if I consult a certified credit counselor and get out of debt, and even if I go to a financial advisor and know where to invest, what does it matter if I still spend everything I make just to survive? Now, that's a question we sadly hear a lot. Even once you get out of debt, you might not have a lot of free floating cash to invest or save, but that's exactly why you need a spending plan. So you can find a few dollars here and there, and you might not that you might not have otherwise noticed. For example, one easy tactic is to deposit your tax return into your retirement account immediately. You shouldn't be banking on this money anyway. You shouldn't be budgeting your tax return for your daily expenses, so putting it directly into your retirement account is a great way to max out your 401k, your IRAs, everything like that. And obviously, no one likes to hear the words "create a budget." It's not any fun. I do it every day, and it does not become fun after 500 tries, but it's definitely productive and very effective. Earlier, we mentioned how easy it is to keep a budget online through your bank or your credit union, or through a variety of online tools like Mint, Taylor, or LifeCU's My Money. Once you do that, I guarantee you'll find at least a few bucks here and there. It might mean drinking one more cup of coffee at home rather than buying it at a coffee shop. It might mean one more brown bag lunch. But when you start to see incremental results, it only encourages you to budget more and save harder. It can be addictive, saving, as weird as that sounds. Accumulating money slowly is one big reason we talked earlier about that free debt analysis from a certified credit counselor. Imagine saving money without sacrificing that cup of coffee out. The average credit card interest rate these days is hovering around 18%. That means that 18 cents on every dollar you carry on your credit cards is going to someone else. Now imagine if that was going into your retirement account instead. If you pay off those credit cards, you start paying yourself. And if you can't pay them off yourself, you call for help. You might learn about something called a debt management program. Now that might reduce your monthly payments by up to 30 or even 50%, but even if it doesn't do that, you might be able to pay off your debts in 5 years as opposed to 12 years on a debt management program. So either way, you save time and money. Okay, so how much exactly do you need to save for retirement anyway? Now, the experts spell it out like this. 1 second, I think I might have missed a slide. No, I didn't. Right. Now, if you're in your late 30s, then you should have the amount equivalent to 1 year of your gross annual salary saved. By 45, you should have 3 times your annual salary saved. At the older end of Gen X, by age 55, you should have 5 times your annual salary saved, and by 65, you need 8 times your annual salary saved. And that's to retire comfortably. Now, if those numbers seem impossible to hit, they're not. When you create a budget and balance it, when you pay off your credit cards and use the interest for yourself, you've taken 2 giant steps. And what if you have student loans? Well, just like there's a DMP program, a debt management program for credit cards, there are similar programs that you can help you reduce your monthly payments for the student loans. Now, they may have odd, similar-sounding names like income contingent repayment plans and income-based repayment plans, but they work. You could ask your certified credit counselor to point you in the right direction. I definitely suggest you do so if that's something you're struggling with. Now, if you're watching this and under the age of 50, here's some specific advice to help you retire comfortably. Like we discussed, you want to max out your 401k contributions, at least up to the match your employer provides. Why leave free money on the table? A Roth IRA is also something you should explore. And if possible, go for the max there. And in concert with your financial advisor, look at other investments that might slowly grow your net worth. You want to look for something that will steadily grow with as much risk as you're comfortable with. Now, what if you're over 55? If you're starting to worry, there are things you can do. In fact, the government realizes your predicament and lets you make extra contributions to your 401k and Roth IRA above what everyone else can do. For 2019, the catch-up 401k contribution is $6,000. What's that mean? Well, it means you can save beyond the limit that everyone under 50 can. Now let's do the math. The limit for 2019 for everyone else is $19,000. Add your $6,000, you're allowed to save extra in 2019, you come out with $25,000. That's the max savings. Now the max contribution for your traditional and Roth IRAs is $7,000 in 2019. Now you may have other help available too. The AARP offers many programs and a lot of solid advice, all for a measly $16 a year. That's slightly more than a Netflix account. For everything that they have to offer, it's truly a great deal. So, as we discussed earlier, you can start making penalty-free withdrawals at 59.5, and at 62, you can access your Social Security. But remember, the earlier you start claiming Social Security, the less you'll get. And finally, Medicare kicks in at age 65, which is a big help considering that healthcare is a major concern for retirees. Now, what if you're watching this and you're already 67 years old? Well, you can take your Social Security benefits, but if you wait 3 years until you turn 70.5, that can translate into hundreds more per check, depending on your particulars. And as we mentioned before, you can start taking withdrawals from your 401k. Although Roth IRAs have no age requirement for yourself, the account must be older than 5 years to avoid all penalties. Now, there's a few things to remember. Whatever age you are, this advice applies. Keep your debt down to the bare minimum so you're not making interest payments to other people. Make a retirement budget so you know exactly what you'll need to make for your golden years to be truly golden. And spend some time looking into Medicare options. Otherwise, you could be spending a lot more on healthcare than you need to. And I'll say it again because it's the most important and profitable lesson here today. Get rid of the credit card debt so you can pay yourself the interest. Do whatever you can to pay off those credit cards. So instead of paying your credit card company that interest every month, you're putting it right into your retirement account where it's growing for you. Now, if you don't know how to accomplish that on your own, don't give up. Pick up the phone. Life Credit Union and Consolidated Credit are allies in destroying your debt. Just say the word, and we're there for you. Now, again, remember, Life Credit Union can help you with your financial goals and challenges. Retirement is just one piece of the financial puzzle that Life Credit Union can put together for you. Financial freedom is an attainable goal, but let's be honest, the path leading there is fraught with peril. Life Credit Union can light the way for you, making it easier to get there quickly. And when it comes to the principles of financial education that will help you save for retirement and everything else, it's hard to cover all the concepts in one webinar. So visit lifecu.org for more helpful information or contact Ann Wires directly at ann@lifecu.org. Life Credit Union is there for you for life. And finally, please make sure to take the survey after the webinar and make sure to tune in next month. Our June webinar topic is student loan repayment. So I just want to say thank you again from Coffee and Consolidated Credit. My name is James Matthews, signing off. Have a good one.